Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that.
New York coffee. The market here has been subject to two separate head and shoulders pattern. The first is a small December 25 to January 26 head and shoulders top for dark blue extension, currently at 303 3/4, which is now below the 309.90 to 312.5 congestion area. And that's overhead. And it's now entering into the smaller 301.55 to 303.40 congestion. The second was a more recent February to March reverse head and shoulders pattern with a bright red neckline, currently 293.55. That was breached higher in late March, but the breach was limited with an even smaller breach higher last week, also failing, such that prices are now getting squished in between either the dark blue neckline above or the bright red neckline above, and supported by the bright green October 23 today uptrend below, currently at 280-285. Additionally, to add more to the mix, we have the 50% Fibonacci line of the January 23 to February 25 move in there at 286.10, mainly acting as a support or an attractor, or else eroding the bearish pressure enough that something else could come in and act as a stronger support. All these pressures, bearish or bullish, are coming towards a cusp. And that's the 50% Fibonacci line, the bright green uptrend. They're already too close to differentiate. And next, the descending bright red neckline will cross over the bright green uptrend in the middle of May. And I suspect, given how shallow the angle is between these two, that we will not have to wait that long to possibly see something happen. Something that could be dramatic. With this in mind, I'm very close to retiring my two targets above, target X at 319.35 and target X1 up at 327.65 for the original break higher out of the start of February to mid-March reverse head and shoulders pattern. I'll keep them on for a little longer, but I have some doubts about them now. As I said 4 weeks ago, something that has also become somewhat prescient when I said, and I quote, "My concern is that this reverse head and shoulders pattern, instead of becoming head and shoulders bottom, becomes a rarer head and shoulders continuation pattern." End of quote. Something else I'd like once again to look at here, and for this I'm indebted to Ray Bradbury for asking me about this, about New York coffee 53 weeks ago. And I went at the time to my longer term charts, the monthly charts, where we can see some possible insights. You see, on my monthly longer term charts, I noticed back then a pattern that had not been immediately obvious to me at the start of 2025. It was a multi-year, 2012 to 2024, very large reverse head and shoulders bottom for a bright red neckline on my chart, my monthly chart, currently at 278.45. The break higher over this neckline reached its primary target on the upside and just about reached its harder to achieve secondary target. Then the market turned lower, and over the course of 2025 and now into 2026 has formed a very, very, very large double top pattern based on that bright red neckline. However, prices have not as yet triggered it, and one could also say the market's having problems trying to trigger it. So where now? Well, consecutive closes below this bright red neckline, assuming of course no false breaks of course, we would have such a double top pattern with all the implications such a move lower might have. Please just remember these patterns here on this monthly chart are longer term patterns. In some cases very long term patterns, and I cover them more fully in my long term technical analysis video published back in January. In the meantime, please just keep that bright red, slightly breached but not yet broken neckline, currently at 278.45, please keep that in your mind. London coffee. 44 weeks ago I said of the bearish pressure on this market, and I quote, They now have the overhang of the market from roughly 5,300 up to this year's high at 58.49, sitting above. End of quote. This overhang of bearish pressure and ammunition is important, as it started back then to press down, magnifying the breaks lower. The main overhead resistance since then has been the dark blue February 25 to date downtrend, which is currently, let me have a look at that, is currently at 39.44. This downtrend had enough of an impact on me back then that I drew a parallel bright red bear channel based around it, and that's currently 31.66 to 40.41. We are today below some previously significant resistances that have turned into supports and back into resistances. Notably, the trio of interesting 50% Fibonacci lines. The first is November 21 to February 25 move at 38.08. The second is the May 21 to February 25 move at 36.49. And crucially, the third is the March 20 to February 25 move at 34.81, which is a little bit above the current market. So if all these moves lower, what now? Well, I said 8 weeks ago, and I quote, might take a leaf from New York Coffee's book and look at the last 3 weeks' actions as a possible descending small scallop pattern. End of quote. This seemed a likely case back then, and I went as far 8 weeks ago of laying out a primary target X down in the 34.15 zone, with a secondary harder to achieve target X1 down in the 30.04 zone. I added at the time, and I quote, we'll now see over the coming weeks if this vicarious analysis from New York Coffee works here. End of quote. 6 weeks ago, we reached target X down at 34.15, and 3 weeks ago powered through it, gradually heading downwards towards the lows we saw in July last year. I'm still optimistic of reaching the secondary target X1, despite the distance lower and the obstacles we have in between. Now, back in February, we started to create a small early February to late March bright pink bear channel, which has morphed into an early February, to date, still bright pink descending wedge pattern. It's currently at 32.61 to 37.35. 2 weeks ago, prices broke down through this pattern, but have been stopped from heading lower by the bright pink red lower bull channel line. I said 2 weeks ago when we saw the break lower, and I quote, for now I will not set targets for this break lower, but instead rely on target X1 for now. End of quote. Now this is the same still case today. I still favour let's see target X1 achieved before we start looking at anything else. Finally, I drew 9 weeks ago something I've been thinking about for a couple of weeks prior, an October 25 to late January 26 bright green bearish Andrews pitchfork. The market has tested and breached the overhead bright green upper time a few times, which is currently at 33.29, but we've not stabilized over it. So for now, I'll keep this bright green bearish pitchfork, this Andrews pitchfork, on my daily chart, but I recognize the bullish impact the lows from July may have on this market. It was, as I said 9 weeks ago, and ever since, and I quote, I have no qualms about morphing this bearish Andrews pitchfork to a shallower bearish shift pitchfork for the same move if the action requires it. End of quote. Please note the bright green upper time crosses down through the bright red lower bear channel line on or about the 12th of May. A potentially interesting day here.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.